This is Ed Meisegland. I'd like to welcome you to today's webinar, Due Diligence. A little bit about me. I've been practicing in the business brokerage for approximately 28 years. And due diligence is always a challenge. It's always a challenge when we're dealing with buyers and sellers, because deals, as you'll remember from previous webinars, deals fall apart either for value or emotional or various, and approximately 20% are other reasons why the deals fall apart. But due diligence is the cornerstone, or you could probably look at it from the standpoint of it is the process, it is the speed bump to go from offer to approaching closing. This is a necessary evil of the process, and it is time consuming for the buyer. It is time consuming for the seller, and it's an emotional time for the seller, because someone's climbing through all of the seller's financial data, operational data, and things like that. So it's a hard time for them. So today I'm going to talk to you a little bit about what due diligence is, how to prepare for it. We're going to talk about financial due diligence, and financial due diligence is one of several, but it's probably the most integral to a successful sale. And then lastly, we're going to talk a little bit about the process of due diligence. So what's due diligence? The first thing is, this is the process that a buyer undertakes to understand and evaluate the business before it's acquired. And the process is to evaluate the things that have been presented by the seller to the buyer, or through a broker, whomever, however the buyer is reviewing that information. They are going to now vet out whether or not that information is true and accurate, and how they perceived it or how it was presented. So the due diligence is going to answer, should we proceed? And if so, should we proceed with what has been offered? And the buyer is looking at it from the standpoint of, is the value I'm getting more than how much I'm paying? So let's start with the process. When is due diligence done? So often we run into business sellers that show up and they say, you know what, we've been working with a buyer, and this buyer has strung us out for a couple months, and we still don't have a deal. So what typically happens is that a buyer will approach a seller and say, look, I'm interested in your business, but before I make an offer, I need to dig into your business a little bit. I need to understand. I need financial statement. I need tax returns. Oh, you know what? Let me go talk to some of your customers. Before I can decide whether or not I'm going to move forward, let me talk to your management team. All of those things are just riddled with landmines, every single one of them. So the process, there's when we as a brokerage, as we present businesses, there's a systematic way of doing it. And step one is that we prepare a teaser, or what we call a confidential business profile. And it's just a germane document that we use on all of our marketing material. And it should be so nondescript that anybody can see it. But it has enough information of the kind of business it's in. It is, the size of it, general area, and that is the lead for the buyer. The buyer now will look and say, all right, it fits my initial requirements. I'm going to contact the broker or the seller, and this is what we're and I'm going to take that next step. And then that next step is to become qualified. One, you got to execute confidentiality agreements. 2, you got to be financially qualified. 3, you got to be operationally qualified. After that, then we move into providing enough information that that buyer can make an informed decision on moving forward. And in our world, that's called a confidential business review, or some people call it confidential information memorandum, or CIMS. Others call it prospectuses. But whatever it's called, it has enough financial data, operational data, market data that the buyer and his or her advisors can look at this and know whether or not they can take the next step. So this document should be able to then be presented to a lender in order for the buyer to have enough of information to gauge whether or not they have an interest. That's it. After that, it's time to move into the acquisition process. Okay, and that's when the offer starts. So I always tell everyone, everybody assumes that the brokerage role is more, that it's finding the buyer. No, it's not finding the buyer. That's getting the buyer is about 30% of what we do. Keeping the deal together once we have the buyer is the other 70, and that's what we're talking about. So we look at offers. It's time for the buyer to make the offer. Once the offer is mutually agreed upon, then we move into due diligence and financing. And sometimes those are reversed, but generally speaking, that's what we're doing at that point. So we have the framework of a deal, and now we have an understanding of where you're coming from, and we accept it. And now we're going to move into removing contingencies, one of which is due diligence. So, Mr. Buyer, what do you want to see in order to satisfy you that the information that we're presenting is what we say it is? Again, we move into financing. After that financing, we move into legal. Legal is the memorialization of that document or of the deal, and then we move into the closing process. Okay, there's different types of due diligence. You have legal due diligence, financial due diligence, which we're going to spend a lot of time today on. You have operational, personnel, insurance, technology, and environmental. So legal, it's, is the business set up legally? And when I say that, for example, do you have the right to sell the company? We had a situation where one of our clients, he was a family member, but he did not have the legal authorization to sell the company. Now, mom and dad they didn't have a problem with it, but nevertheless, he had represented and warranted to us that, he was in the driver's seat and he could do what he wanted with the permission of his folks. So legal flushes out, and that's just a basic side, but legal digs into, is the company organized as it says, as well as the other exposure that they may have, whether it be with warranties or outstanding matters. Financial will dig into operational. So let's look at processes and procedures. Somebody wants to know, how does your business work? What's the flow? Take me from the start, from the very start of you, number one sale, all the way through collection for that sale, and how does the business operate? Then we look at personnel. Tell me about the personnel. Tell me about their benefits. Tell me how long they've been there. Tell me about any problems that they have. Tell me about any garnishments. Tell me about any trouble spots, any lawsuits or disparaging remarks that personnel might have on their record. Insurance. What kind of exposure does the company have? What is there? OSHA related stuff? Is there buy sells? Is a buy sell funded by insurance? Where is the insurance lies. So there's more due diligence there. Technology. We look at different companies that, especially some of these older companies where baby boomer business owner, it works fine the way it is. Whereas someone, 45, 50 years old coming through saying, you know what, we can put a CRM system in here and the efficiencies will be considerable. We can have considerable more throughput. Well, you need to evaluate the technology within your company, and it's not necessarily a deal killer, but the buyer needs to understand what kind of technology horsepower is within the company. And then lastly, environmental, especially if we're dealing with real estate, everybody wants to know, is the land dirty? And if so, how do we remediate it? So let's dig into financial due diligence. And this is pretty important because, this is where the biggest roadblocks that we plow into is financial. And like we talked about before, is put yourself in a buyer's shoes. What are they looking at? Because they have a myriad of other opportunities. When they're looking at your opportunity, what are they seeing? So when they look at your financial statements, they're looking at irregularities. They're looking at, why is your payroll so high? Well, in my case, it's my kid's on the payroll. Okay, well that explains that. What about lawsuits or non-recurring expenses? And if you'll remember, we talked about adjusted cash flow, and that's why we do that, is so any kind of irregularities that might be embedded within an income statement, we want to be able to show that. Same thing on the balance sheet. We want to extract those assets that are not material to the ongoing running of the company. So we also want to address risks of the business. As a business owner, we've talked before that basically a T-chart, left-hand side, talk about why someone wouldn't want your business. On the other side of the T-chart, talk about why somebody would. And that T-chart will lead you to what needs to be addressed, because the buyer is going to focus guaranteed on the left side. Next, have an optimal tax position. When we look at tax positions for our sell side clients, we always say we do our valuation work, and we always say, you may want to run some tax scenarios based on this value on what would be optimal, because certainly the buyer is going to. Buyers coming in, chances are, if it's a first-time buyer, it's one thing. If it's a company buying another company, they're coming in and they know what their structure is, and so they've got a little bit of a leg up on the seller. And that's why we always tell our sellers, you got to do valuation work, or you got to have an idea of what your value is, so the advisor, your peripheral advisors, are in a position to help you, on what is the optimal framework for a potential deal at all times. Next, you want to flush out problems. We talked a little bit about that already. So what are the other benefits? Well, it improves negotiating leverage. When these next couple things, negotiating leverage, mitigates confidentiality breaches and credibility with the buyer. They're all kind of lumped together. And the reason I say that is when you're dealing with a buyer, and as the seller, you can give them, basically anticipate everything they're going to ask for, at least initially. From a buyer standpoint, it's like, holy moly, this guy is ready. Not only ready to sell, but he's in a position where he, meaning the seller, is in a position that he can, if you, Mr. Buyer, don't work out, I'm moving on to buyer number 2. And I'm committed to the sale process. So keep that in mind. So objectives. Again, the buyer or the target company is trying to understand the business more holistically. It's trying to assess risks. It's trying to identify what creates and drives value. It's trying to identify where are the opportunities to optimize the transaction. Will it pay for itself? Are there any ancillary synergies that might be available as a result of combining companies? And lastly, is it predictable? And what we want the buyer to excuse me, what the buyer wants is confirmation of what they thought they were getting is in actuality what they are getting. So, understanding the business holistically. First, we talked the risks are internal and external. Internal are financial risks. We talked a lot about that already. Operational. Let's talk about how business flows. Tell me about processes and procedures and why, how is all that documented? Because a buyer is looking at, okay, if I walk in here, can I run the business day one? That's ultimately the question. And there's always there's training and transition that goes on, but the buyer is more skeptical than that, and they should be, because can I actually run the business? So having documentation of this is how we operate. This is how these are the closing procedures. These are this is how sales works. This is how we acquire customers. This is our cost per customer. A couple books that if you're so inclined, Traction is a good book. It's the Employee Operating System, as well as The E-Myth by Michael Gerber. Those are two good books if you want to review those. Human resources. When we think about human resources, again, we touched on this already, but the buyer wants to understand who he's dealing with. Where are the risks? We have an automotive shop that we've been doing some work with, and the mechanics, the average age is mid-50s. Well, the question is, what are they going to stay after the sale? And his answer is, I don't know. Well, from a buyer standpoint, what do you think the buyer's saying? Well, I don't want to stroke you a check and have to turn around and go find other buyer or other, in this case, mechanics. So understanding ages, motivations, problems of the employees is integral. And then lastly, infrastructure. Everybody wants to identify and evaluate what the culture is in the business. So understanding what that infrastructure is certainly important. Moving to external, we have to look at technological obsolescence. There are times where whether it be equipment or technology, there's some obsolescence there that has to be addressed. And when we're talking about that, we look at the company, and especially some of the older family-run companies where this is how we do it. I understand that lathe is 50 years old, but it still works. Well, okay. Well, would it serve the company better if you purchased a new lathe? How much more throughput could it be? How soon could it pay for itself? And so the buyer is evaluating that. And guess where the value ding is going to come from if they find technological obsolescence, right? It's coming from right off the top of the value. Next is, where are you in the life cycle? The product life cycle. If you're manufacturing something, what is the likelihood that your product is still going to be around in 10 years? Well, because, why 10 years? Well, 10 years is the magic number. Is that's the typical age of an SBA loan. So at the end of 10 years, do I still have a business? And then lastly, are you being disrupted? We see this a lot in retail. I mean, Amazon's not going away. So what are you doing to offset what Amazon's doing to the entire retail sector. Next, mitigating short and long-term risks. So we talked about financial statements. So we're looking at quality of earnings. And when I say quality of earnings, so you have a tax return. Does a tax return reconcile to the financial statement? Does a financial statement reconcile to the QuickBooks? Does QuickBooks reconcile to the deposits and to the invoices and all that? So there's one big long line of reconciliation. So that's the first and the last point here. So when we're looking at that, or when the buyer's looking at it, they're just trying to make sure what you say is indeed accurate. And that leads into the financial statement reporting. So many business owners that we work with tend to tend to only do financial statements once a year. Well, guess what? That's probably not good from the standpoint of a management of the company. And one guy I remember, he said, if there's money in the bank account, we're good. Well, I hear you, but from a buyer's standpoint, it's, oh my goodness, if you're not, who's managing the company? The other thing is concentration. When we're looking at, when you're looking financially, where's the customer concentration, or is there? The rough rule of thumb, if it's 20%, we've got to address that in a hurry. Same thing with suppliers, and if there's supplier issues, supplier concentration, if there's no alternatives, again, value challenges there. We look at trends in comparison against the industry. So what is the industry doing? Are we growing? Is it volatile? Where do you stack up against your peers? And again, this is not condemnation. It's just assessment of risk. Next is we move over to the balance sheet. So let's look at the assets being acquired. What are they in good condition? Is there, like I said in the last slide, is there technological obsolescence? And if so, what do we do about that? Same thing with, are there liabilities that are on that balance sheet that I might be responsible for? And then lastly, related party transactions. If you have kids or spouses or friends embedded in the company that may or may not be doing anything, those relationships need to be assessed, whether or not, it's an easy one. If somebody's on the payroll and not doing anything, it's easy to say, all right, they're not gonna matter post sale. But if they are doing something, then we have to evaluate how are we going to replace them. And then lastly, we look at, or second to last, we look at policies and processes, and then the management hierarchy. When we say that, who does the work? Is there a tier of management? Is the owner the whole business? So we have to look at management. Which brings us to value creation and drivers. Starting from the top, we look at financial performance, then we move into growth. What's the likelihood that we're 10 years from now? What does this thing look like? And I'm not asking you to be able to forecast 10 years. I am asking whether or not whatever you're producing or the service you're providing, are you going to be relevant in 10 years? The next thing is it's called the Switzerland structure, but it's not necessarily, but what that means is, are you dependent on anybody? Customers, suppliers. Valuation teeter-totter that we talked about. The valuation, tell me about the flow of cash through the business. That's what that means. Remember, every buyer is writing 2 checks to a seller, one for the business, and then not 2 checks. One is going to the seller, the other is going to fund working capital. Driver number 5 is recurring revenue. Do you understand how the business runs? Customer acquisition. Do you have recurring revenue either through various channels? Can you make the business work without your direct involvement. That recurring revenue, if you're so inclined for some summer reading, it is a book called The Automatic Customer by John Warillo. There's 9 different types of new customer type methodologies in order to get that recurring revenue. Monopoly, where do you fit in? Where is the buyer, or I'm sorry, where is the seller as we talk about monopolies? Where do you fit in the marketplace? Do you command it? Are you first mover? Are you in the middle of the pack? How do you differentiate yourself? Then we move into customer satisfaction. What's the likelihood that your clients or your customers are going to refer you? And then lastly, we look at how much of the business is you. So that's how we assess, or the buyer will assess, value creation and drivers. So to optimize the transaction, a buyer, especially if it's a company, is looking at a few different places. One, people. If my company's buying your company, I'm looking at what I can absorb and do away with in your environment. Okay. For example, if I have accounting, okay, I have accounting back room, and it's just a matter of absorbing it, and we'll handle all billing, we'll handle everything. I don't need your 2 staff accountants that are running the back room. Okay, so all that immediately falls to the bottom line. So company buying other company is looking at that. Tax opportunities. Again, when we're looking for optimization of tax opportunities as well as structure. Excess capacity. This has more to do with rent and location. So my company has 100,000 square feet of excess space, and you just happen to your lease is up, or you don't want to sell your real estate, or you have another buyer for the real estate, I can roll it into mine, and all the rent that has been paid to you drops again to the bottom line. So I do want to stress that, especially in the people side, because I know a lot of the business owners that we work with, their employees are more than just employees. They're family in a lot of cases, sometimes real family, and other times they're like family. And what I want to draw attention to is the majority of the time there seldom is that much of a change, because part of whether it be an individual or whether it's a company, they're not going to make immediate changes. They're coming in, ignore the movies for a while. What they're buying is the employees. The employees create value. Will the acquisition pay for itself? So any acquisition, all right, we have to establish how much cash flow is the business generating. From that cash flow, we have to answer a couple things. One, can it pay me? Can it pay my management team or me or whomever is going to operate the business? Can it support the post-acquisition debt? And most importantly, can I get my money back through a return of my investment and a return on my investment that, excuse me, is favorable as compared to other alternative investments? Right now, we're seeing roughly 30% return on with the risk associated with small business. So that was one of the questions that came through. Lastly, back to company on company, the synergies. Where are the synergies? And I touched upon this on a couple slides ago. Is 1 + 1 = 3. By me acquiring you, where can we augment each respective business that either we can cross-sell, or we can pick up excess capacity, or we can capitalize on facilities. All those things establish synergy. And when we can do that, obviously it amplifies the transaction. And then lastly, is the business predictable? With greater predictability is greater value. So any investment, if you understand, that's why if you look at real estate, the returns on the investment are lower, but the values are higher. You follow? But they're constant. There's less it's less likely that you're going to lose your shirt in buying real estate. So again, greater predictability, the greater the value. So one of the questions we have is, how do you prepare? Well, first, and this is just a short list. One, make sure your financials are in order. Two, any kind of regulatory matters that are hanging out there, don't care what they are, you need to make sure that's squared away. You may want to Google yourself just for yucks so you can see what is out there. Most of our workflow here at our shop includes that, where we want to know what you've been up to, because somebody is going to do that due diligence. It's better for us now to learn about what may or may not have happened, so we have explanation. Not that it may make a difference. It just puts us in a position that we're not surprised. Next, any kind of agreements that you might have. And when I say agreements, buy-sells, supplier agreements, leases, non-competes, agreements with employees, any of those, you got to assemble those. And lastly, if you have any kind of intellectual property, whether it's a franchise or whatever, you do need to make sure that is in order so someone can review it. And lastly, and most important, disclosed problems are almost always surmountable. Almost always. And always remember that a buyer is going to find out. So we've had a number of sellers over the years that think that they're going to pull something over on the buyer, and it just doesn't happen. Somebody is going to learn that somewhere along the process. Now one of our future sessions, we're going to talk about financing, the different types of financing. So when we're dealing with this type, we're talking seller financing, and I know most sellers cringe at the thought of seller financing. But the problem and the reason that it's deployed as it's risk mitigation. So if for whatever reason the information that you provided me is wrong, intentionally or unintentionally, I have your attention because I owe you money. And so if I pick up the phone and I say, look, Joe, you said that X, Y, and Z. If you want that money, you certainly are incented to help me out. And if for whatever reason it goes post-closing, again, it's back to seller financing, that fixes it. But you don't want somebody, a lawsuit coming up from behind because of misrepresentation or something you thought you were going to pull over and it's your business now. Well, it doesn't work that way. Okay, so a couple more things. First, the questions that we had. So how soon before I decide to sell should I gather this information? We always recommend, always be ready to sell. You may get an unsolicited offer. Someone shows up at your doorstep and says, look, I'm interested in your company. Having that stuff compiled, whether it be in Dropbox, Google, virtual data rooms, somewhere where it's all together. So if and when that would come, you are in a position to say, all right, let's start. And either you could contact us or whoever you choose to do to serve as an advisor for you. They will need this information. So the more organized you are, the easier it is for everyone in the process. All right, so as we move into what's next, we've had a number of calls and emails and such that various different questions. So for July, we're going to do something a little bit different. Is we're going to have basically office hours. So I think we have 4 hours a week that you can just call, and if you have a particular question, give us a call, and we're happy to talk about whatever you might want to talk about as it relates to this. I know we're seeing a lot of people asking about valuation and price positioning and things like that. So this gives you an excellent opportunity to go ahead and do that. So Chelsea will have the link in this presentation. She will have a link to the calendar, so you can click it, decide when's a good time for us to visit, and we'll be happy to do that. And then lastly, in August, we'll reconvene with our next webinar, which will be Deal Killers. So again, thank you so much for your time and attention. If there's any questions, you'll certainly have the opportunity to reach back out to us. And again, we're grateful that you spent your time with us. Thanks again.